The Federal Reserve raised its target interest rate by 0.75 of a percentage point to a range of 3% to 3.25% on FOMC meeting September 2022. So far, the Fed has raised interest rates 5 times in a row since January this year, and since June, the Fed has decided to raise interest rates by 75 basis points at each of its last 3 meetings, maintaining the strongest single rate hike since November 1994. Although the 75 basis point interest rate increase on Wednesday was predicted, the market still plunged after Jerome Powell, chair of the Federal Reserve of the United States press conference. S&P down 1.71%, Nasdaq down 1.8%, and Dow Jones down 1.7% on the day. What exactly did Chair Powell say in his speech, then, that sent the market plunging? Let's take a look at the FOMC meeting. First, let's look at the economic projections of Federal Reserve Board members. This is the assumptions of every individual Federal Reserve Board members and Federal Reserve Bank presidents. They will do this every 3 months. We can see from the change in real GDP, they have lowered the percentage if compared to June projection. The median projection for real GDP growth standing at just 0.2% this year and 1.2% next year. However, the June projection for this year and next year was both 1.7%. Chair Powell also mentioned we will see a GDP that well below the median estimate of the longer-run normal growth rate in coming quarter. The projections of unemployment rate next year was increased to 4.4% from 3.9%. If we look back the historical data, the previous great inflation in year 1982, the unemployment rate was 10.8%. So, unemployment rate also one of the indicators will affect the inflation. Try to imagine if the employment market is strong, every people have job and money, then they will keep spending and the inflation will not come down. The projection of PCE inflation was not much difference compared to June projection. So does the core PCE. However, the federal funds rate is the important indicator we should focus on. The federal funds rate for this year increased from 3.4% to 4.4%. This means after the 75 basis points interest rate hikes at this meetings, there will be 125 basis points raise by the end of the year. This is even higher than the earlier prediction made by the St. Louis Fed President James Bullard, one of the hawkish member in Federal Reserve member. The terminal rate was expected raise until 4.6% in 2023. The terminal rate is defined as the peak spot where the federal funds rate will come to rest before the central bank begins trimming it back. June projection was only 3.8%. This figure shows target range for the federal funds rate of each FOMC participants. Each dot represents the target of FOMC members. After this meeting, only one FOMC member believes that the federal fund rate should be increased by 75 basis points. This was the Bullard's earlier prediction. Bullard's estimate was nevertheless viewed as hawkish by the market at the time. However, the other FOMC members are becoming more hawkish. All of the FOMC members agree that no decrease in interest rates is expected for the upcoming year. This is some Q&A from the press conference after the FOMC meeting. We can see the first question. The journalist asked when to stop the interest rate hike. Chair Powell said his main message has not changed at all since Jackson Hole. Personally, I think Chair Powell wants to deliver a hawkish message to market. They will see the GDP growth and labor market. And they will only consider slowing down increase interest rate when they saw the inflation moving back to 2%. Actually, the response was rather formal and did not provide us with much information. Then let's see the question 6, why not 100 basis points increase? Chair Powell said that data for July was good but for August was bad. But if we see the data for August, the inflation was actually go down, but the inflation was not go down as expected. So, we can said that Fed will only satisfy when the inflation go down and beat the expectation of the market. Let's see the question 8 now. The journalist asked about the employment rate. Chair Powell said there is no other way to do it painless. I think that Fed increased the interest rate while the economy data seems good was a wise decision. Because we can foresee that the labor market will only become bad when the interest rate increase. If they only increase interest rate when the economy become bad, they will only face more pressure from political side. In conclusion, after I saw the press conference of Chair Powell, the Fed is way more hawkish than market expected. For long term, I think this is quite good. Because we all know the inflation will only be more sticky if they didn't increase the interest rate hardly. But what will change Fed decision? I think only when the inflation drops sharply or the unemployment increase tremendously. However, these were merely my opinions, so they could be wrong. Because despite having just over 400 PhD economists on staff, the Federal Reserve Board consistently makes predictions that turn out to be incorrect. Without mentioning us. But knowing about these macroeconomic statistics is important so that we can at least psychologically prepare and not freak out if the worst happens. The only thing we can do is alter our portfolio in accordance with market conditions. If you have other opinions, let's comment below. Please help to like and subscribe.